Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for December 13th of 2021. Please see our disclaimer for important information. As we get started this week, we'll take another quick look at our high-frequency data provided to us by our friends in Chicago, First Trust Advisors. You can see here that we have a little bit of pullback in certain areas, TSA checkpoint data. That is week over week number, and we've seen a little bit of a deterioration there as we've seen the emergence of the Omicron variant, but at least month over month it's down only 2%. We're still showing relative progress there. Global commercial flights, we're seeing more inventory. Obviously, we're in the midst of the holiday season, so I expect that number will look a lot better by the time we get to the end of the month here. Supply of motor gasoline up slightly in the week, down a little bit month. Again, more Omicron related there. Open table, a little bit of a mixed message, but overall, most of the recovery is intact. Maybe a few little hiccups here and there. Hotel occupancy up for the week, down for the month. But again, the holiday season, that'll pick up. And then if we look at more of the industrial and commercial sectors, rail car traffic, steel production. Steel production's been down a little bit lately, but we have seen overall manufacturing remain very, very strong. And obviously rail car traffic, as we're trying to get through the supply chain choke points, remains fairly stout in trying to get product to market and to the end customer by the Christmas holiday there. So we'll talk a little bit now about inflation and kind of get our arms around this a bit. Here's the consumer price inflation, CPI. You can see the headline number in black, and in the orange is the what we call the core index, which is excluding food and energy, which as you can see here, its influence on the black headline number is pretty profound. It's very can be very volatile, and this points out the obvious as we go back to 1990. In this particular data series, you can see that we've really spiked lately, and you can actually see from this chart that this continued, especially paying attention to the orange line, this secular decline in inflation that we've seen over really a few decades now, as it started off in 1990 when we had a bit of a recession around the advent of the Gulf War. There, you can see that overall inflation has really come down over a period of many, many years here, and it's only recently spiked for a lot of different reasons, not the least of which is pandemic related. But we do think, again, that this number is going to settle in higher than it has been, and we're going to see a little bit of a new paradigm where perhaps it settles in, maybe 2.5, which would be kind of the consistent level of inflation that we saw in the mid 90s, which is actually consistent with a period of rising short-term rates by the Federal Reserve. Now, if we break down the consumer price index by its components, it's clear to see, and this is why I think the Fed really finally came to the conclusion that I honestly think that most of the rest of us already knew, that there's a lot of this inflation that's not going to be transitory. But you can see in these component category bars here in this particular chart that you can see the outsized influence of both food and particularly energy in this. So that's orange and blue there, and then the black is durable goods, and we have a chart on that to show you the pronounced inflation that we're seeing in durable goods. And it really, as you can see, for all of almost the entirety of this year, there have been no components that have been disinflationary per se. I mean, all of these components have contributed to inflation, whether it's rents, owner equivalent rents. We know those are picking up. Transportation services, we know used car prices, rental cars, all of that has gone up. Other services is kind of a catch-all basket for a lot of different things, but you can see that these have all contributed to inflation, and in fact, in some cases, particularly in food and energy and even durables as well, have actually accelerated as of late. So here's the chart that I was mentioning on durable goods price inflation. And actually, as you can see, when dating back to 1995, a period in which we really began to accelerate globalization, global supply chains, so on and so forth, that we actually had a negative price influence from durable goods. We had kind of a secular period of almost a deflationary impulse from the durable goods sector for many, many years, and that's just recently reversed itself, which is quite interesting and profound to watch at the same time. Now, 8%, I'm not sure is terribly sustainable. I do think that probably levels off, but I think durable goods for the time that we're going to have to deal with the supply chain choke points, which I'm guessing is at least another year to some degree, and global demand picks up. We've got a chart on how that looks positive out on the horizon, and notwithstanding the current Omicron variant impacts, but we do feel like that there's going to be a demand factor that's going to keep durable goods price inflation above zero, but not necessarily where it is now. On the right-hand side is just a continuation of the time series that we're watching on home prices, and this is well understood over the last year, and it's a supply and demand choke point. We're struggling to get affordability for new home buyers, and there are price kind of frictional barriers to folks, to mobility, to folks selling their home for a high price, but then having to pay a high price for where they're moving to. In the orange line, you can see the home price index, and that's on the right-hand scale there. Home prices are up in the last reading here of December 6th. They're up, essentially 20% year over year. And we know that rents typically follow at a lag, and you can see the black and the gray lines there, which represent rents and owner's equivalent rent, which is a fairly meaningful component of the CPI index. In fact, it's probably 23 to 24% of the overall index, and it's about 30% of the core index, which strips out that food and energy. So it's very meaningful, and to see that turn higher again is something that we're going to have to monitor, even though the levels that we're seeing right now are in terms of annual growth rates are not as high as we've seen them over the last 5 years. We'll talk about wages for a second. This is the Atlanta Federal Reserve Wage Tracker, and this is a fairly widely used and studied data point. And you can see that the recent trends in wages have not are really indicative of kind of a longer term trend. You can see the dip there when we hit the global financial crisis, and wages, as we have tightened in our labor markets, have gone up consistently, although these are microscopic changes that, if you're not really paying attention to this chart and this time series, that you could easily miss. But wages have been going up for actually quite some time. They kind of stalled out around the middle of last decade in terms of their growth rate, around 3%. And, we kept watching for wages to begin to break out, which is, in my view, kind of a potential determinant of where we're going to see inflation. Now, we have seen that because of the tight labor market, which, again, we might be back to full employment here before too long, as the Fed kind of defines it. And if that's the case, then I think that this time around, wages will be stickier at a higher level. I don't think they're necessarily they're going to stay well above 4 long term. I think short term, that could certainly be that way. Most of the wage pressure we're seeing is in the lower skilled categories. And we've got a couple charts coming up to kind of show you where that wage pressure is really, really coming from. Well, here's the chart that I mentioned. So we've got two different views of this. On the left-hand side, we've got the service sector inflation. And you can see that orange line there, that represents leisure and hospitality. And we know that that's, that's the kind of the COVID trade, if you will, right? So all of the entities that shut down, that reopened, trying to expand their businesses, but they can't find the workers. So they're having to pay signing bonuses. Average hourly wages are moving much, much higher in leisure and hospitality. It's been really tough to find labor in that category. And so not too surprisingly, we see a very strong, over 12% year over year increase in wages in leisure and hospitality. However, that's not to say that we haven't seen it in other areas. So in total, that represents the black line. We know that that's moving up, and it has been high for well over a year now. Now in transportation and warehousing, that number is also moving higher. We're about 6 to 7% up year over year in wages in transportation and warehousing. And we know Amazon and a lot of the shippers are looking for talent right now, and certainly the overland trucking business is looking for a lot of talent. On the right-hand side is kind of a snapshot of kind of before and after. They kind of underscore this point here. So black bars represent 2015 to 2019. And you can read these categories: leisure and hospitality down to manufacturing, construction, business services, retail. All of these numbers have spiked. So this is a fairly broad-based move in wages. So maybe where we've seen kind of the most impact in some of the service sectors and the lower wage categories, we've seen a lot of wages accelerate in a lot of different areas, including manufacturing and including wholesale trade and construction. Now, as we've been talking about all of these areas where we've seen pronounced wage pressure, obviously transportation, logistics is one of them. But the interesting dynamic here is that in this reopening economy, if you will, we've seen, obviously we've talked a lot about the supply chain choke points, and a lot of it has to do with overland trucking, and but there's a lot of elements of transportation that are in significant growth mode right now. What's interesting on this chart, you can see the breakout in the job openings for transportation. So this is one area where you can say that there are a lot more job openings than there are people able to fill it. And so what that is translating into is this interesting wage dynamic. But as you can see here, in a relatively short period of time, we've seen a tremendous spike in the number of job openings here in the transportation sector. Now, as we divert away from wages for a second and talk about something else that's been really meaningful in terms of its impact on inflation this year, and that's energy. So energy accounts for about 7% of the total consumer price index, but over the last year, it's contributed almost a third of the inflation impulse that we've seen. And here you can kind of see that depicted in these various lines. So natural gas, which is really important in terms of power generation in our country. In many areas, it's supplanted coal. And so it's very meaningful to watch natural gas. And you can see that those prices this summer were up 100% year over year. Now, on the crude oil side, we were relatively depressed post-pandemic because of all of the shutdowns and the kind of curtailment of economic activity. But those prices have rocketed and essentially more than doubled. And you can see that in the orange line, which is crude oil, and then gasoline, which is a distillate byproduct of crude oil, and obviously a very strong barometer of mobility and activity and economic growth. You can see those prices are up way, way, way high. So you can understand why energy has had an outsized influence on inflation over the last year. However, looking ahead though, and this is from Bloomberg, this represents kind of a composite of what the expectations are looking forward. And so the markets estimate future growth in prices via the futures curve, and the futures are contracts which are priced to provide a certain delivery of this these commodities at a future point in time. And so when you take the composite of these futures contracts, you can see the prices that are implied. And so what we're looking at right now is a rather pronounced deceleration in not only the rate of growth, but maybe even a deflationary impulse by the time we get to the end of next year, meaning that prices will decline from current levels. And as a result, I think this, and I've said this before, I think this actually provides a bit of an offset to some of the other inflation areas that we expect to remain high, like rents, wages, and to some degree, maybe commodities in the production chain. But we do think energy is going to moderate a little bit next year and kind of help to keep inflation a little bit lower. And one of the other things that's really important to inflation is actually money velocity. And so, kind of what is that? Well, it's a measurement of the speed at which money is turning over in our economy. So if you think about it, in an expanding economy, you're having more turnover. M2 is a pretty broad definition of money supply. It includes basically all liquid forms of currency in circulation, checkable deposits, short-term time deposits, so on and so forth. And velocity is a measure of how quickly that's turning over. So you go to a store and buy a product. Well, then the money that's earned by that vendor is turned around and they buy more inventory. And the people that are selling them the inventory are buying trucks to deliver it to them. And the people that are, delivering trucks need the trucks maintained and they need to buy trucks to go deliver. So on and so forth. So there's a money multiplier effect that's at work here. And so, in an expanding economy, which we have had over many years, you would expect to see velocity pick up. Now, as I mentioned at the outset, velocity is important to inflation, in which case, all the liquidity that we've had in the market over the last several years, really the last decade, if you will, if that money were being spent, you'd see much higher inflation. But the reason why we haven't is because this velocity is actually trending down, and it kind of almost came to a standstill here during the pandemic. And what does that mean? It just simply means that people were parking liquid resources. You could see a lot of excess bank deposits, and certainly banks were then sending their excess reserves to the Federal Reserve, and you could see the Federal Reserve's balance sheet really spiking up. So a lot of this liquidity that was injected in the market over the last decade really hasn't been put to work in the multiplier effect. And that may be one reason why we really haven't seen the kind of growth overall in the last year that we have. And it's certainly one reason why we perhaps have not seen the level of inflation that we are certainly now seeing in the market. And so what's interesting, what will be interesting to watch, is what happens to the turnover or the velocity of money given the fact that we have a lot of liquidity in our economy right now. And right now you can see, at least in this data point, which is as of the end of June, that we really haven't seen the spike up in velocity yet, but would expect that to be the case going forward. This is data from RSM, which is an accounting and consulting firm. This is their supply chain index, and this is kind of just a revisit of where we are in the supply chain issues. And the light blue represents recessionary periods, and the black line represents the RSM supply chain index. We've had last week, I believe, we had a chart related to inventory to sales ratio, which is that number in the green. And so basically supply chain by the index here is trailing off, which we know in some areas we're getting a little bit of relief on supply chain, and other areas we're not, like semiconductors. So by their index, we're still in kind of a clog point. And again, I think it's going to be the better part of 2022 before we move past that. As a result, we're not getting as much production and inventory on the shelves as we would like, certainly not enough to meet the demand. And that's where you see that line below zero, and we're actually in negative territory on inventory to sales which I think as we slog through this supply chain problem next year and we gradually work it out, that the inventory rebuild that will come from that, I think will be a meaningful component of overall economic growth next year. And it's one reason why I actually feel reasonably decent about the economic backdrop heading into the next 12 to 18 months. Something else that I thought was really interesting that came out of the RSM research that I read this week was the foreign purchases of U.S. Treasuries. And you think about it, other areas of the world, especially Europe, are going through this Omicron variant, a very uneven global recovery, if you will. Some areas are doing well. We are in a global recovery, but it's, like I said, it's not been even across all areas. And U.S. has much higher overall interest rates, although we bellyache that our real interest rates net of inflation are still negative, but they're still a lot better in a relative sense than other countries across the globe. And so there's still a definite interest in U.S. Treasury purchases. And we know that, if we're financing, all of the spending, that we need to issue more Treasuries. The good news is there that foreign demand for the Treasuries is really high, and you can see that depicted on the far right of this chart. Now, what are the implications of that very briefly? And that's when you have more demand for your Treasuries, that increases your price, but correspondingly that reduces your interest rate. So foreign demand to some degree has helped to keep interest rates low, and particularly in our, call it our 5 to 10 year maturity range for U.S. Treasuries. So a chart that I think underscores, the comment that I made a few seconds ago regarding the global recovery. And so, this overlays the U.S. Manufacturing Purchasing Managers Index. PMI with the global manufacturing. You see that there is a relationship, a positive relationship between the two. U.S. has clearly exceeded their prior levels. And I think to some extent the global manufacturing PMI has done the same thing. Directionally, they're moving the same way. And this is a diffusion index. So anything above 50 represents expansion. And anything above 60 represents outstanding expansion. And we're at that point right now. Global PMI is picking up, but it's still well into positive territory. And so this is another reason, another data point or data series that gives me a lot of comfort looking out into 2022. So we look at we were talking about money supply before and the velocity of that money supply. This is a chart that just overlays nominal U.S. gross domestic product, which is basically U.S. economy, U.S. economic growth, on top of real U.S. GDP, which just subtracts inflation. And then you've got your M2, your supply of money, that's in that gray line. So as you can see, as inflation has picked up, the real rate of economic growth is separating from nominal. So we're having a little bit more inflation here, but you can also see that the rate of money supply growth has really picked up, and its relevance to overall economic growth is not to be underappreciated, even though a lot of that excess supply of money has been, as I said, parked on the sidelines. Financial conditions, by and large, remain positive. And you can see this time series that goes back to 1995, and the recovery post-pandemic, we're at a positive level, and financial conditions remain conducive for economic growth, remain conducive both for businesses as well as the consumers. This is a composite of a lot of different information, but obviously you want to see that positive and perhaps trending higher. Even if we're not necessarily trending higher, we're at an aggregate high level. So we've got a lot of these underlying indicators that make up this index moving in the right direction to help support growth next year. However, say financial conditions are set to tighten, and the big reason why is the interest rates are expected to move higher. That much is clear, and that is the primary reason why financial conditions are set to tighten. And so while we have this economic backdrop, we have to nuance through this period of rising rates. And that's not, it shouldn't be considered kind of a proverbial four-letter word. It really should just be something that we embrace as part of an economic recovery. That we had abnormally low interest rates, we've had abnormally or below trend inflation, and those two go together. But looking ahead, obviously I think we're looking at higher levels of inflation, which should actually correspond to higher interest rates. And so naturally you'd see a tightening impulse in financial conditions, but the optimism remains fairly strong. And I do believe that the economy can well withstand tighter overall conditions. It just might make maybe the equity market, the stock market, and the investment markets may be a little bit more volatile. All right, this is a chart on the wealth effect, and this is just basically the rise in values of homes for homeowners, rise in value of your 401k because the market's going up, or your other individual stock holdings or whatnot. You can see the wealth effect is actually pretty strong here, and so directionally you can see both the world as well as the U.S. I mean, we've had a fairly strong response after the pandemic. Stock markets went down, and so that had a negative impact. But after the stock markets began to recover, you could see that those numbers were moving higher. Now, if you overlay that, or maybe just place it side by side with inflation, which is on the right side of this, you can see core personal consumption expenditures, which is kind of an inflation measure that the Fed really pays attention to. You can see where that has moved higher, and so this chart is actually making the case that the wealth effect, while it's very positive for economic growth, very clearly and very demonstrably positive for economic growth, but it can also help to inspire inflation. And how does that happen? I think it sets the stage for increased, as we call it, velocity of money. So more transactions, more activity, more money turnover can actually, from the wealth effect, as people monetize some of this wealth and put it into the economy, could be inflationary and can contribute to the inflation that we're seeing. Switching gears and looking at the corporate sector. Now we know consumers have been strong, but what does the commercial sector look like? Well, when you look at the largest companies, and S&P does a good job, it represents about 85% of the economy, if you will, in terms of its size and industry distribution. And you can see that total liquidity or cash on the books for all the companies in the index is exceptionally high right now. And so there's a lot of dry powder. And the other thing that I think is important, from an economic growth standpoint, aside from the consumer and consumption, but also investment, which is another of the main components of economic growth. Investment is important, and that when you think about companies being flush with cash, they have the ability to make significant capital expenditures. And you can see that the announcements on intentions on spending capital have increased, and also actual investment has really been picking up lately. You can see that here on the right-hand side with the Goldman Sachs CapEx tracker, as well as private non-residential investment numbers. Well, and when you see an improving economy, you see maybe the makings of increased velocity and turnover of money, and you see the inflationary impulse from supply chain choke points, from wages, from rents. That gets the attention of central banks, not the least of which is our own Federal Reserve. But just overall, you can see here in this chart where over the last several years we've enjoyed a considerable impulse from rate cuts, and particularly 2019, 2020 across the world, frankly. And this is a global indicator here that we've seen a lot more cuts than hikes in 2019, 2020, but that's reversed now. So we're seeing countries around the world, as we're kind of normalizing they are increasing rates at a faster rate than they're decreasing rates. And so and when you think about that and you look at that upgrade downgrade ratio for high yield issuers, there's a much more optimistic backdrop, which is allowing the central banks to kind of begin to normalize interest rates. And on the right-hand side, again, you can see that ratings for issuers of high yield are improving. So there's a higher confidence level overall that the economic backdrop is improving globally and should expect to continue to improve over the next 12 to 18 months. So we talked about the household, and this is really the evidence as clear as I can show, household currency and really liquid deposits. And you can see the tremendous increase. Some of these are, the transfer payments from the government, the higher income folks that receive those payments largely just saved them. But overall, if you look at across the entire economy, you can see a really strong spike in currency. And so this is pent up liquidity that can be spent in the economy. And this is a reason why I feel like there's some staying power in this economy long after this peak growth period, that we could have this growth being supported by the consumer, which is 2/3 of our economy, for a long time. Equity market volatility. We've got some charts on the equity side before we kind of conclude here. But if you look at that, this is volatility during recessions. And we haven't had volatility, really a lot of volatility this year, with the exception of kind of recent history here. And you can see typically during expansions, volatility remains fairly low. But we have had bouts of higher volatility, and I do think next year will be one of those periods. If we look at the S&P 500 operating margin, really high. So as we kind of bounce between the consumer and the commercial sector, this is something that gives me a lot of comfort for the health of the corporate market, for the health of the stock market, frankly, because you've got operating margins that are really high. So even if there are inflationary impulses where maybe there's elements of inflation that companies are saying that they can't pass along to consumers, that there's an awful lot of cushion in their margin to be able to absorb some of that and not have operating margins necessarily go below their long-term trend line. This is something I've alluded to, and I found this chart in Charles Schwab and Liz Ann Saunders' piece, and I thought it was really, really good to illustrate the point that I've been making, that even though we have had very little volatility in the overall market, we've had really significant volatility within companies that comprise the market. And so just take the top one, for example, the S&P 500. Year to date, through really the end of last month, over 20%, and 79% of the index members have a positive return, and some have a really positive return to help drive that plus 20% year to date return. However, in that third column, 92% of the S&P 500 has had at least a 10% drawdown from its year high, a year-to-date high. 92% have had a 10% drop So again, while the index itself hasn't been terribly volatile, 92% of the stocks within it have had bouts of pretty significant volatility, and that last column underscores that the average member of the index has had an 18% drawdown from its high. So, we've had, declining breadth in performance. That means that fewer companies are trading above their moving averages, their 200-day moving averages, and that we're still seeing a lot of impulse coming from a more limited subset of stocks. It's a chart that kind of highlights what the style outlook should be. What I mean by that is what kind of style investing will be favored after we begin to see rate hikes. And in this chart, it shows you that rate hikes are kind of symptomatic of an improving economy, of a Fed that is trying to control growth while trying to promote full employment. And so you typically see cyclical stocks that companies that perform well in an expanding economy where the Fed is trying to manage growth for a market cycle. And so that's why value, which is in that blue line, value tends to perform well after the first rate hike. And so that would be a reason why we're adding value to our portfolios now. Momentum doesn't do quite as well. Momentum does a lot better, at a different point in the cycle, but value really should eclipse that when you hit kind of in the first year to two of a rate tightening cycle. S&P 500 12-month forward price to earnings ratio. This is just bringing you up to speed and kind of drawing a timeline for you that, we haven't seen levels this high since 1999 and really on the advent of the tech bubble correction. But they're not as high as they were back then. We have seen a spike, but that's only because we've seen strong profitability, as we certainly saw recently here in the margin chart. But prices and multiples have actually come down a little bit. Now, long-term average is about 16 or so, and we're still above that, but we're not at a level that I think is eminently negative for the market. Treasury yield curve has moved up, and certainly the expectation of an accelerated pace of short-term interest rate increases by the Fed has inspired this move in the curve. So, where we've seen the most change has been really in the 1 to 10-year part of the market, and really long-term rates, which are much more driven by long-term inflation expectations, remain fairly anchored, and they haven't really changed that much. They've, in fact, almost made kind of a round trip year over year to almost the exact same point that they were this time last year. Well, with all of this expectation being built into the market, and looking at the yield curve, you can see this illustrated in these two charts here. So the probability of 3 Fed rate hikes in 2022 is almost 100%, and that's a complete sea change from even literally just 3 months ago because of this inflationary impulse that we've seen in the market. And it's really gotten the attention. And also, it's important to note that the Fed and this realization that maybe a lot of this inflation is not transitory and they will be with us for a while, has certainly begun to price in the likelihood of having multiple rate hikes next year. As a result, there on the right-hand side, you can see the tremendous move, and in a relative sense. I mean, this is a big move for the 2-year Treasury to have moved, essentially, almost tripled, more than tripled in in its level from earlier this year. So if we look at this and kind of look forward, this is kind of like drawing some conclusions from the past. And, so we're talking about yields rising, interest rates increasing. That's all well understood. It should be, I think, interpreted positively, unless we see a bout of unanticipated inflation. But in this chart, you can see that there is a relationship with potential economic growth to the 10-year Treasury. And as we look at going forward, that we feel like, the 10-year Treasury yield is going to be moving higher, but that generally corresponds with economic growth. And I think this chart kind of shows you how that relationship works. And so, I feel comfortable with the notion, again, that rising rates are not necessarily bad, that it can be associated with positive economic growth. We'll end on a couple of, I guess, pandemic-related items here. This first one caught my eye. It just highlights the production rate for vaccines in the next year. I think there's obviously been a big push to get boosters lately to help combat maybe the symptoms or the significance of maybe what the infection from Omicron might look like. But clearly there's going to be a supply response by all these manufacturers, about 5.8 billion overall doses this year and almost $12 billion doses next year. And we'll end on this slide, and this is something that I thought was really interesting, that, as we've kind of like glide through this latest Omicron issue, or the wave rather, you can see a rather dramatic decline in the mentions of COVID in stories. Now it's still out there, but it's not the main thing right now. I mean, I think we've clearly identified inflation as the main issue in the investment markets, in the corporate boardrooms, on the front lines with retailers and distributors. Inflation is the big deal right now. I think by and large, this economy has kind of figured out that, we're not going to be able to get rid of COVID. We'll have more variants, but the medical community and the response, and as I just showed you, the manufacturer's response on vaccines has been fairly strong, that that's not going to be an anchor to our growth. If anything, it's going to be the inflation moving forward. That's all I got this week. Hope you've enjoyed the information provided. And on behalf of the entire team, hope you have a wonderful week, safe week, and we'll talk to you again soon. Take care. Bye-bye.